Hello, everyone. Thank you for taking the time to join today's informative webinar. My name is Jacob Shelton, and I'll be your host for today's session. Today, we'll be focusing on a variety of investment options that are available to U.S. expats, particularly concerning our retirement accounts while we're living abroad. This is a crucial topic as understanding these options can significantly impact your financial future. It's important to note that many of the points we discussed today are relevant to our brokerage accounts, but there can be a wider array of options available in that area. Please keep in mind that the statements I'll be making are generalized and may vary depending on the specific country in which you reside. If you have questions regarding the particular treatment of an account in your country, I encourage you to schedule a free consultation with me at a later date. I'm here to help you navigate these complexities. Allow me to introduce myself a little bit more personally. I'm an expat myself, currently living in the beautiful city of Marbella, Spain, down on the southern coast, alongside my wife, Emma, and our adorable golden retriever puppy, Daisy. I'm originally from Portland, Oregon, and definitely grateful that I'm here in Spain when I check the weather forecast this time of year from back home. My journey in the financial services world began in the United States, where I spent the first 10 years of my career in wealth management at firms such as Morgan Stanley and JP Morgan. This experience has provided me with a deep understanding of the many challenges that U.S. citizens face when it comes to investing, especially when we move abroad. The transition can be daunting, but with the right knowledge and guidance, it can also be a rewarding experience. To kick things off, we'll delve into the different types of retirement accounts that are commonly used by U.S. citizens and explore the various options available for each. Following that, we'll discuss how U.S. expats can effectively manage these accounts and what changes occur when transitioning from living in the States to living abroad. Finally, we'll examine the actual underlying assets that you can invest in and how to define what might be right for you. Despite some misunderstandings surrounding the laws and regulations, it's entirely possible for your investment portfolio to resemble what you had access to while residing in the US. This is an important point to clarify, as many expats feel limited in their investment choices once they leave the country. Let's begin our discussion with 401k plans, which serve as a cornerstone of many American retirement strategies. These employer-sponsored plans offer significant tax advantages that can greatly benefit your long-term savings. When you contribute to a traditional 401k, you're using pre-tax dollars, which effectively lowers your taxable income for the year. This means that your money can grow tax-deferred until you decide to withdraw from during retirement, allowing for potentially greater accumulation over time. For expats, it is crucial to understand how your 401k fits into your international lifestyle. If you're still employed with a US company, you may have the opportunity to continue contributing to your 401k plan. However, if you've left your American job for a different position, you'll still have several viable options to consider. One is you can leave your money in the old plan if that's permitted by the plan provider, which it typically is for these employer-sponsored retirement plans. You may choose to roll it over into an IRA or individual retirement account at a cross-border compliant institution, which can provide you with more flexibility and investment choices. Alternatively, you can transfer the funds to your new employer's plan if your new employer is US-based and has a plan available that allows for foreign addresses. Each of these options come with its own set of pros and cons, especially for expats. For instance, rolling over to an IRA might give you a broader range of investment choices, but it is essential to work with a provider who understands the unique issues faced by expats. This includes ensuring that the correct tax reporting documents are prepared both for the United States and your new home country. As we navigate through these options, I encourage you to think about your own situation and how these strategies might apply to you. The goal is to empower you with the knowledge that you need to make informed decisions about your retirement accounts while living abroad. Remember, the landscape investing as an expat can be complex, but with the right guidance, you can successfully manage your investments and secure your financial future. With retirement accounts for rollovers for expats, timing is absolutely crucial. Remember that you're only allowed one rollover per account type in a 12-month period. Otherwise, there can be additional penalties and taxes. It's a common mistake that I see. Remember, the IRS views a 401k distribution, not a rollover, as taxable income, even if you're living abroad. This means that any funds you withdraw from your 401k will at least be subject to US taxes, which can be a surprise for many expats, although you might pay taxes in the country of residence first and get this amount credited back if there's a dual taxation agreement in place. Therefore, doing these distributions correctly in a timely manner can save you considerable taxes, allowing you to retain more of your hard-earned money for your retirement. It is essential to consider various factors that can significantly influence your financial outcomes, such as currency exchange rates and your current versus future tax bracket. These elements can have a profound impact on the amount you ultimately receive from your retirement accounts. Moving on to individual retirement accounts, or IRAs. There are two main types of IRAs that everyone should be aware of: traditional and Roth IRAs. Traditional IRAs operate in a manner that is very similar to 401ks. Contributions made to a traditional IRA are often tax deductible, which can provide immediate tax relief. The growth of your investments within the account is tax deferred until you make withdrawals, at which point the funds are treated as taxable income. This means that you still owe taxes on the amount you withdraw during retirement, which can be significant consideration for your long-term financial planning. On the other hand, Roth IRAs are funded with after-tax dollars. While you do not receive an immediate tax break when you contribute to a Roth IRA, the money you invest grows tax-free, and qualified withdrawals in retirement are also tax-free. This can be particularly advantageous for expats who may find themselves living in a higher tax bracket country, or when they come back to the United States, if they choose to do so at some point in retirement, they're in a higher tax bracket country as they're living in the US. For the year 2024, the contribution limit for both types of IRAs is set at $7,000 a year if you're under the age of 50 and $8,000 a year if you're 50 or older. However, it's important to note that eligibility for making contributions and the ability to deduct these contributions from your taxable income depend on several factors. This includes your income level and whether you're covered by a workplace retirement plan, as well as whether the country you reside in recognizes the deductible contributions against your taxable income. As an expat, there are additional tax implications that you must consider when it comes to IRAs. The Foreign Earned Income Exclusion, or FEIE, can complicate your ability to make IRA contributions. If you would choose to exclude all of your foreign income under the FEIE, you might find yourself ineligible to contribute to an IRA for that particular tax year. However, if you have your US source income or foreign income that exceeds the FEIE limit, you may still be able to contribute to an IRA. This option might make sense depending on the country in which you reside and the respective income tax rates. For instance, if you live in a country with lower tax rates and still have remaining taxes to pay on your income in the US, then contributing to an IRA could be a beneficial strategy for you. Conversely, if you're residing in a high tax country and typically do not have to pay any income taxes in the United States, then making contributions to an IRA might not be the most advantageous choice. For business owners of a US-based company, establishing a SEP IRA can be an excellent way to lower your taxable business income while simultaneously saving for your future retirement. This type of account allows for higher contribution limits compared to traditional IRAs, which can be particularly beneficial for self-employed individuals or small business owners. It's also worth noting that many countries may not recognize the tax advantage status of your IRA, which could potentially lead to double taxation on your retirement savings. This is why it's crucial to have a solid understanding of both US tax laws and the tax laws of your country of residence. Consulting with a tax professional who specializes in expat tax issues can help you navigate these complexities and ensure that you're making the most informed decision regarding your current accounts. Now, while 401ks and IRAs are the most common types of retirement accounts, there are certainly other types of retirement accounts that you might encounter depending on your own profession. This includes 403B plans, which are typically offered by public schools and nonprofit organizations, 457 plans, which are often utilized by state and local government employees, and the thrift saving plans, or TSPs, designed for federal employees and uniformed services. Each of these accounts has its own unique benefits and features, and understanding how they work can help you make the best choices for your retirement saving strategy while living abroad. These plans share many similarities with 401ks, but there can be important differences in contribution limits, investment options, and distribution rules that are crucial for expats to understand. For those living abroad, the key considerations remain largely the same, but they can take on added significance in an international context. One is can you continue contributing while abroad? Do these contributions lower your taxable income in your country of residence? Two is, how does your country of residence view these accounts for tax purposes? For example, here in Spain, we do not tax any type of distributions from TSPs, but we'll still tax distributions from 403Bs, and both can still impact your taxes through the wealth tax here. Often a misconception is that Spain doesn't tax any type of government pension, including for teachers, but 403B plans are still taxed on their distributions. And three, what are your options for managing these accounts from overseas? Do you still have the ability to make changes to the actual investment allocation? It's essential to remember that maintaining these accounts while living abroad can be quite complex. Many US-based financial advisors may not be equipped or licensed to handle the unique situations that expats face. So it's crucial to work with financial professionals who not only understand the unique challenges faced by Americans living overseas, but are also licensed to work with foreign residents, particularly in the country where you currently reside. Having the right guidance can make a significant difference in your financial planning and retirement strategy. Now, let's delve a little bit deeper into the differences between traditional and Roth accounts, as this decision can significantly impact your retirement strategy as an expat. Understanding the differences is vital for making informed decisions that align with your long-term financial goals. The primary difference lies in the tax treatments of these accounts. With traditional accounts, you can receive the tax break now, which can be beneficial for your current financial situation, but you'll pay taxes on withdrawals as income later when you retire. In contrast, with Roth accounts, you pay taxes now on your contributions, but you can enjoy tax-free withdrawals in retirement, which can be a significant advantage. For expats, the decision becomes even more complex due to the various factors that can influence your tax situation. You need to consider your current tax bracket compared to your expected tax bracket in retirement, the tax laws and treatment of each account in your country of residence, as these can widely vary, and potential changes in US tax laws, including required minimum distributions, or RMDs, and retirement ages, which can affect your planning. Your overall financial goals, such as estate planning and the desire to provide financial support to your children. Roth accounts can be particularly attractive for expats in certain situations. If you're living in a country with higher tax rates than the US, paying taxes now while working and living in the US on Roth contributions can be advantageous, allowing you to maximize your retirement savings and not have to pay additional taxes when you're actually retired and taking these distributions. When it comes to rollovers, expats also have some unique opportunities that can be beneficial. For example, you might consider converting a traditional IRA into a Roth IRA, also known as a backdoor Roth IRA, in a year when your taxable income is low. This could happen if you have a small IRA and you're taking advantage of the Foreign Earned Income Exclusion, or FEIE, which allows you to exclude that income that would be treated as a withdrawal from that traditional IRA. But before you do anything in your long-term planning, consider the following: is how many years before you'll actually need to access the Roth account? The longer you leave the money in the account, the more it can grow tax-free. Will the Roth account be a part of your estate plan? Remember, Roth IRAs don't have required minimum distributions, which can be beneficial for estate planning, allowing your investments to grow without the pressure of mandatory withdrawals. And how does your country of residence tax withdrawals from retirement accounts? Some countries might not recognize the tax-free status of Roth withdrawals, which could impact your overall tax strategy. In that case, you may either want to liquidate or rebalance your Roth account before moving abroad in order to avoid being double taxed on those assets. If you have the choice, even moving to a country for a year to become a tax resident there that would recognize these tax-free withdrawals for Roth can be an important tax strategy, especially for those as digital nomads. And what other assets do you have? Diversifying between traditional and Roth accounts can provide tax flexibility in retirement, especially if you're moving back at some point during your retirement to the States. Balancing Roth accounts with other assets is crucial for a well-rounded retirement strategy. They can serve as a tax-free pool of money in retirement, complementing other taxable income sources. This balance can help you manage your tax liabilities more effectively and efficiently, and ensure that you have the resources you need when you retire. As an expat, navigating the complexities of retirement accounts requires careful consideration and planning. By understanding the differences between traditional and Roth accounts, and by working with knowledgeable financial professionals, you can make informed decisions that will benefit your financial future while living abroad. The landscape of retirement savings can be intricate, but with the right information and guidance, you can successfully navigate these options and secure your financial future. No matter in which country you currently reside, it is extremely important that you keep your retirement accounts custodied within the United States. I can't stress that enough. No other country has the ability to receive 401k, IRA, or other types of US-based retirement accounts and maintain their tax structure. Moving these accounts to another institution that claims to be able to hold them offshore can lead to dire tax consequences that could significantly impact your financial future. The complexities of international tax laws means what may seem like a convenient solution can actually result in unexpected liabilities. Which brings us to one of the largest challenges for expats. One of the biggest hurdles is finding qualified financial advice tailored to the unique circumstances of living abroad. Many US-based advisors are just not equipped to handle the complexities of expat finances, and the vast majority are prohibited from working with overseas clients due to regulatory constraints. This lack of access to knowledgeable advisors can leave expats feeling vulnerable and uncertain about their financial decisions. It might be tempting to use a US address to maintain relationships with US financial institutions. However, this approach can carry significant risks. If discovered, it could be seen as fraud, potentially resulting in forced liquidation of your assets, which could be a devastating outcome. Always be transparent about your residency status with your financial institution to avoid any complications that could arise from a misrepresentation. Accessing your retirement funds while living abroad can also be tricky. Some US financial institutions may restrict or freeze accounts for overseas residents due to concerns about money laundering or regulatory compliance. It's crucial to work with institutions that are experienced in serving expat clients. I'm currently working with a couple who just received a 60-day notice from my old company, JP Morgan. Their accounts are currently frozen, and we are rushing to open new ones so that when the accounts are liquidated, they won't have a tax consequence from liquidating their IRAs and will have a new place to hold these funds. This situation highlights the importance of proactive planning and the need to have a financial strategy that accommodates the realities of living abroad. Estate planning can also add another layer of complexity to the financial landscape for expats. US retirement accounts are subject to US estate tax laws, but your overall estate may also be subject to estate or inheritance taxes in your country of residence. Careful planning is needed to avoid double taxation and ensure your beneficiaries can easily access the funds you intend for them. This requires a thorough understanding of both US and local laws, which can vary significantly. Beneficiary designations are particularly important and should be reviewed regularly. Make sure they're up to date and consider the tax implications for your beneficiaries, both from a US perspective and their own country of residence. This is especially crucial if your beneficiaries are living in a different jurisdiction, as the tax treatment of inherited retirement accounts can differ widely. Managing your investment portfolio as an expat requires a nuanced approach that takes into account the unique challenges of living abroad. First, let's talk about risk tolerance. Your risk tolerance may change when you move abroad due to factors like currency risk, geopolitical considerations, and changes in your financial goals. Understanding how these factors influence your investment strategy is essential for long-term success. To assess your current risk tolerance, consider your time horizon. How long do you need to access the funds? Have you thought about when you would want to retire? Are you already retired and need immediate income to fund your lifestyle? Understanding your timeline can help you make informed investment decisions. Next is your financial goals. Are you saving for a specific purpose or just for the general income throughout retirement? A specific purpose could also be a child's education or for a home purchase, either in the US as an investment property or in your new country of residence. Clarifying your goals can help determine the appropriate investment strategy and asset allocation. It's crucial to align your investments with your actual financial goals. If you need to generate monthly income to support your current lifestyle, even while you're working, your investment strategy should reflect that goal. Next is your comfort with market volatility. How do you react to market up and downs? Emotions can often get in the way of investing, causing many nervous investors to sell at the market's bottom, which can be one of the most detrimental things for your portfolio. For those investors who are aware of this tendency within themselves, it can be significantly more effective to have a portfolio with lower volatility, even if it means sacrificing some future potential gains. This approach allows you to maintain a sense of stability and peace of mind, which is crucial for long-term investment success. Behavioral finance plays a significant role in investment success, especially for expats who might feel disconnected from their US-based investments. If the market experiences this volatility, are you likely to panic and sell, or do you instead see it as a buying opportunity? Understanding your own tendencies can help you create a portfolio that you're comfortable maintaining for the long term, allowing you to avoid knee-jerk reactions that could jeopardize your financial well-being. By recognizing your emotional responses to market changes, you can develop strategies to counteract impulsive decisions and stay focused on your long-term goals. Currency considerations are also important. As a US expat, you're likely dealing with multiple currencies, of course, including the US dollar, and then your local currency in your country of residence. Your investment portfolio should be structured to manage currency risk effectively and potentially take advantage of currency diversification. For example, if you have a property purchase coming up, buying a futures contract for that amount can help to stabilize the amount of dollars you will spend, allowing you to plan around it with greater confidence. This strategy can mitigate the impact of currency fluctuations on your purchasing power, ensuring that you're not caught off guard by sudden changes in exchange rates. Next is the regulatory environment. Different countries have varying regulations regarding investments and retirement accounts. Stay informed about the rules that apply to your situation to avoid potential pitfalls. By taking these factors into account, you can develop a comprehensive portfolio management strategy that aligns with your risk tolerance and financial objectives. The proactive approach will allow you to navigate the complexities of investing as an expat and ensure that your financial future remains secure. Navigating the complexities of retirement accounts and investment strategies requires careful consideration and planning. By understanding the unique challenges that you personally face and working with knowledgeable financial professionals, you can make informed decisions that will benefit your financial future while living abroad. The landscape of retirement savings can be intricate, but with the right information and guidance, you can successfully navigate these options and secure your financial future. Remember, a well-diversified portfolio can help manage risk effectively. This includes a mix of US and international investments, as well as different asset classes like stocks, bonds, and potentially real estate or other alternative investments. Diversification not only spreads risk across various sectors and geographies, but also enhances the potential for returns, as different asset classes may perform well under varying market conditions. By carefully selecting a diverse range of investments, you can create a more resilient portfolio that can weather market fluctuations. At our firm, we specialize in serving US expats like yourself. We offer customized portfolio solutions starting at 400,000 USD or standardized portfolios depending on your scenario starting at just 100,000 USD, tailored to the unique needs of Americans living abroad. Our goal is to provide you with the financial tools and resources necessary to navigate these complexities of investing while living outside of the United States. We start by conducting a deep dive into your personal situation, covering topics such as estate planning, your country's tax laws, and your future plans. This comprehensive fact-finding process allows us to get a full picture of where you are financially and where you would like to go. As American citizens, we custody your assets within the US while ensuring compliance with your new country's regulatory bodies. This does lead to a slightly more complex account opening process, which with additional compliance requirements. Consequently, it can take up to a month to get an account opened and assets transferred. If you need to transfer your accounts to rebalance before the end of this year, it's a great time to do so and start this process, although we really would need to get the ball rolling, as it allows you to optimize your portfolio in alignment with your financial goals. One of the key services we provide access to is US bank accounts while using your international address. This solves one of the major pain points for expats, maintaining US financial relationships without resorting to using a US address, which can lead to the complications I mentioned earlier. By facilitating access to US banking services, we help you manage your finances more effectively, ensuring that you can maintain your financial connections back home while living abroad. In conclusion, understanding your comfort with market volatility, aligning your investments with your financial goals, and considering currency risks are all essential components of a successful investment strategy for US expats. By working with knowledgeable financial professionals who understand the unique challenges you face, you can create a robust portfolio that not only meets your current needs, but also positions you for future success. The complexities of investing as an expat may seem daunting, but with the right guidance and well-structured plan, you can navigate these challenges and secure your financial future while living your life abroad. We're fully licensed globally, which includes our operations within the United States. The important licensing means that we can continue to serve you seamlessly, regardless of where you decide to move to, or if you decide to move back to the US. Our global perspective is a significant advantage as it allows us to navigate the complex intersection of the US and international financial regulations with ease and expertise. This global licensing also provides us with the ability to continue investing in US-based asset classes, such as ETFs or exchange-traded funds or mutual funds without interruption. This flexibility is crucial for maintaining a diversified investment portfolio that can adapt to your changing circumstances as an expat. It's important to remember that every expat situation is unique. What works for one person may not necessarily be the best solution for another individual. That's why we offer this personalized advice that is tailored specifically to your circumstances, goals, and the particularities of your country of residence. This personalized approach ensures that you receive the most relevant and effective guidance for your financial journey. Now, I would like to open up the room for some questions. I see that we already have a couple. Feel free to add that just in the Q&A box down below. For U.S. rental incomes, I'm gonna go ahead and read these out loud, and so that we can get these answered for everyone. And the questions are: for U.S. rental incomes, what deductions can be applied? Home improvement costs, property tax, mortgage interest, maintenance expenses. So this is really going to be dependent on your country of residence. Many countries don't actually allow for these same deductions that we have in the United States. For Spain, for example, we actually wouldn't be able to apply really any of these deductions other than home improvement costs, unless it's under an LLC that's US based. And so that way we can take them as business expenses and get paid out through a dividend at the end. And so that's just one of the strategies that we can use to still maximize the rental income tax efficiency. Let's see for the next one. For Roth IRA withdrawals and capital gains taxes on them, is it correct that only 15% of the withdrawal is taxed by using the 85 capital / 15 gains rule? That's not necessarily going to be the case, and it will greatly depend on the country that you're living in. Feel free to please schedule a free consultation with me. That goes for everyone, but it's really going to depend on the country of residence that you're in. For Roth IRAs in particular, they can be a little finicky depending on the country. For Spain here, the capital, it's not going to be any particular rule. It's going to be the capital gains that are within that account. And so we can't generalize and say 85% capital, 15% gains, where that might not necessarily be the case for your personal account. Again, feel free to reach out, and so that we can make sure we get those questions answered. Perfect. Next question: can you speak to the tax treatment of U.S. HSA accounts abroad, especially in Spain? They're not going to be nearly as useful as when you were living within the U.S. What I will say is, if you're planning on moving back to the U.S. at any point in time, keep those HSA accounts, and so that you're able to utilize them at that point. There are certainly different insurance programs, especially for ex-military, ex-federal employee, that you get credited back on any type of expenses that you have in Spain for medical purposes, and your HSA can help pay for those back in the States, or any type of insurance cost back in the States. That's not going to be the case for everyone. And you're not going to get that same type of deductibility if you're just a typical expat living in Spain, paying a private insurance. The HSA account is really not going to have that same type of tax treatment, and would really be treated more along the lines of an IRA as far as taking that as income. Perfect. And what are the pros, cons to dual residency in both US and Europe? Well, one is the fact that you get to live in Europe. This question was particular for someone living in Portugal. Under NHR, you can effectively lower your overall tax rate, especially if you live in a state with income tax. But really, the large part of the pro, right, is going to be able to live abroad, live in Europe with most likely a lower cost of living, better healthcare costs. But it's such a personal decision that dual residency can be fairly. That's a tough question to answer as far as a full list. But I certainly enjoy living in Spain. As far as dual residency and moving back and forth, you're really only going to be a tax resident in one of those countries, depending on where you spend most of the time. So typically that's 183 days. It can certainly vary by country, but for Portugal, that does hold true. There is a tax treaty USA-Spain, correct? Yes, there is. Yeah, there's a double taxation agreement, which really makes sure that you're not double paying these taxes. Although there's parts of the treaty, like a Roth IRA, which isn't as favorable. And so for different accounts like that, we really just want to plan ahead, or to, if it's an option, to not use those and maybe use those as part of an estate plan. Do you supply country-specific investment reports in addition to 1099s for the USA? Yes, we do. For every EU country, I believe every Latin American country, most Asian countries, Middle East, of course, African countries it really is country-specific there. But for most of the world, we are able to provide country-specific investment reports. It's a great question. For Roth 401k and Roth IRA, which taxes do we need to pay in Spain? And so that's really going to be, first of all, if you have a Roth 401k and you're not contributing to it, I would recommend to roll it into a Roth IRA, purely for simplicity's sake, and so that you have as many options as possible. If you are living in Spain currently and already have these accounts, I would say that, again, as similar to an answer I gave earlier, they're not really needed for income. Might be a great, strategy to head back to the States for a year at some point, be able to liquidate that entire account tax-free, and then come back to Spain. So that's really going to be a very specific tax strategy if it's a possibility for you. So I would say, definitely reach out and schedule a consultation with me. Broadly speaking, what is your fee structure? Is it proportional to total assets managed, or percentage of gains, or fixed fee? And so typically it is proportional to total assets managed. Just as there's some fixed compliance costs, right? As that total amount grows, the fee really shrinks, just as an economy of scale. But that's typically how we manage the fee situation. Is there any compliance regulations for engaging with U.S. resident clients for their pension accounts? No, just so I understand the question, I believe It's for potentially people who have moved into the US that might already have pensions here in the EU. And there are certainly compliance regulations, right, as they are then in the US. We still have to deal with SEC FINRA. Fortunately, as we are dual licensed, we would be able to do that. And so that's certainly something that we would be able to handle and set up. So please feel free to reach out. Oh, guys, and we are getting just a ton of questions. I have about 30 more questions on here, so I'm going to try to tackle as many as I can. But please bear with me, and if I'm not able to get to your question, then again, feel free to set up a consultation. I will send out an email to everyone who registered with a replay of this webinar and a link to be able to book in for a consultation to make sure that we get all of these questions answered. Initially, a few years ago, I was wanting to retire in Spain, but it was my understanding that I would have all of my retirement accounts taxed at a 45% rate. Is this still the case? It's definitely not the case. Depending on the type of account, again, and the amount that you take from that account each year, it still wouldn't be taxed at a 45% rate, but that rate is a progressive rate on traditional IRA distributions from 403B, 457, from any type of federal government employee plan or specific state plans. It would actually be taxed at a 0% rate. The Spanish progressive tax rate goes from 14.5% up to just about 45%. And so I think that was really, if you're taking quite a bit of income each year, you might reach that rate at the top end of that distribution, but your effective tax rate throughout all of those distributions throughout the year wouldn't be that 45% rate. Are you internationally licensed? Yes, we are. And so, yes, it can certainly help whether you're in the US, in the EU, or really anywhere else around the world. And for citizenship programs specifically, yes, we do have some investment by citizenship or citizenship by investment, programs. Holborn is actually one of the #1 providers in the world for that. If we're looking for the golden visa in Spain, I will say, please reach out as soon as you can. It is going away in January. We still have a little bit of time if we can be on the ball with that to get an application in. But realistically, we would want to start that process by this week. It's going to be a big change. It was just approved by Congress right this past week to shut down that golden visa program in Spain. If you're looking at other countries around the world, we're able to help all over the place. Portugal is certainly a popular one, and we actually have some citizenship by investment options that other companies don't have. So typically it's 500,000 euros to start with that, and we have an option for 350,000, where you actually get paid back the 500,000 as interest through that process. But certainly feel free to reach out on that topic as well. I receive a Department of VA disability pension, which is tax-free in the US. Specifically in Portugal, would that income be taxed? I do want to, let everyone know just in advance. I am a financial advisor, not necessarily a tax consultant, although due to my job with the tax, the cross-border tax implications, I am quite experienced and versed in these. So I will say, right, in Portugal, I believe that would not be taxed, but certainly check with a Portuguese tax consultant. Fairly confident in my answer, but always want to give that disclaimer. Okay, guys, I think that is going to be the limit of questions. I know that there's came in quite a few more in the meantime, but please reach out individually. Again, as soon as I get a recording of this, I'll be able to send that out, which will also have my email address, contact information. So please set up a consultation. Love to speak to each and every one of you when we have a little bit more time. Thanks again for joining. Have a great night.